Welcome to our monthly portfolio review. I'm Amanda Lambert, National Distribution Manager at La Trobe Financial. As careful stewards of your capital, we unapologetically took a very cautious approach to COVID-19. We increased our cash holdings and made a very deliberate tilt towards residential assets. These necessary steps protected investors against volatility and helped preserve the capital and liquidity profile of our portfolio offerings. As the path ahead became clearer, we carefully unwound our emergency settings and have progressively reinvested cash and normalised the asset mix in our portfolios. Pleasingly, this now sees us at an inflection point within our portfolios as incomes normalise. We're always pleased to be measured on the net returns that we deliver to investors. March 2022 concluded with our portfolio accounts maintaining their proud history of never losing a cent of investor capital, of always paying our monthly distributions in full and meeting all redemption requests in full and on time at maturity across each of our portfolio accounts. While interest rates have trended downwards since the global financial crisis in 2008, our account offerings have continued to generate consistent, low volatility, variable income above their benchmarks and paid monthly. We have a range of key portfolio statistics on screen here. Let me point out just three of them. Firstly, as you can see from the third line, number of mortgages, our portfolios are highly diversified. By creating portfolios of highly granular assets diversified across sector and location, no single loan, nor group of loans for that matter, can by itself have an adverse effect on portfolio performance. Diversification remains a key portfolio driver. Secondly, as you can see from the average investment and largest investment lines towards the bottom of the page, we have maintained our discipline of identifying and investing in granular asset exposures. We continue to see material upside in smaller ticket exposures versus many of our peers, and this characteristic has a material positive influence on portfolio performance. Finally, as you can see from the liquidity levels line just over halfway down the screen, we've continued to reinvest our excess cash following a deliberate period of higher liquidity levels. Holding an overweight cash position was, as we touched on earlier in this presentation, a deliberate portfolio tilt through COVID-19. Having commenced this reinvestment bias, our liquidity levels have reduced steadily towards target. Our portfolio holdings remain highly diversified from the perspectives of both sector and geography. As mentioned, through COVID-19, we took a cautious approach with a very deliberate tilt towards increased cash holdings and residential assets. Across the credit fund, we increased residential loans from 61% in February 2020 to 70% at the end of November 2021. These loans are the ideal offset to market volatility and have performed this role admirably. Regular followers will appreciate that through this period we have continued to inform the market about our portfolio performance with monthly email updates, monthly webinars, and the most comprehensive, freely available monthly portfolio reporting in our sector. Some key takeaways which punctuate our current portfolio settings. Our liquidity levels are close to being fully invested. We have begun our tilt back towards non-residential assets. Our geographic allocation broadly aligns with Australia's population base, ensuring we're operating in the broadest and deepest markets available. This portfolio positioning sees us at an inflection point in our portfolios as post-COVID settings and portfolio incomes normalise. Our arrears positioning remains extraordinarily strong even in the face of COVID-19 headwinds, reflecting the resilience of Australia's economy through this period. Our 12-month term accounts 30-day plus arrears are just 2.3% of the portfolio, below the 2.5 to 4% range that constitutes our normal expected range. Hardships are immaterial to portfolio performance, just 0.1% of the credit fund, entirely immaterial and similar to normal pre-pandemic prints. The quality of the loan assets in the portfolio can also be seen from the very low asset shortfall levels. Again, using our 12-month flagship as the example, you can see that just 0.04% of loss over the last 12 months. Over 10 years, that's just 10 basis points or 10 cents in every $100 lent per annum. And to be crystal clear, not 1 cent of those shortfalls has been passed on to investors, who have enjoyed the benefit of our unique investor reserves and who have always received 100 cents in the dollar back on redemptions across all of our portfolio accounts. Thank you for watching our portfolio review. Continue watching for our monthly updates on the economy and our property market and sector update. If you have any queries, please do not hesitate to contact our asset management team on 1800 818 818.